Well, I'm back to the deep dive. Today we're digging into the latest financials from Havells India Ltd. We're looking at their Q2 for fiscal year 26. That's the quarter ending September 30th, 2025. And our goal here, as always, is to kind of slice through the official numbers and figure out what's really going on. How did Havells manage growth when, well, key consumer bits were facing some serious headwinds? And we also want to track, the impact of big strategic moves, like their big investment in solar. Where's the money coming from? Where's it actually going?
Right. And if you just glance at the headlines, the picture seems, well, surprisingly okay. These results came out October 17th. Net revenue from operations. It hit almost 4,800 crores. That's 5.2% growth year on year. But here's where it gets interesting for you, the listener. Net profit after tax, PAT. That grew way faster. It jumped to 16.5% compared to last year, hitting just over 317 crores.
Okay, hold on. 16% profit growth on just 5% revenue growth. Especially when management themselves said the consumer market was weak. That kind of difference. It makes you wonder, right? Is this amazing efficiency, or is something else propping up that profit number?
Well, it's a bit of both, but heavily skewed towards something else. The sources are pretty clear. That big profit jump came mainly from something called other income. Specifically, there was a one-off, non-recurring profit. Over 45 crores. This came from selling land and buildings down in Faridabad. It's tied to moving their switchgear business. So when you suddenly add 45 crores of profit that didn't come from, selling tables or fans, it makes the profit before tax and that 16.5% VPD growth look much bigger than the underlying business alone would suggest.
Right, so strip away that land sale benefit. What's the core operational story? Because that's what tells us about the long-term health. We need to look at EBITDA, right? The actual earnings from the business itself.
And operationally, they actually did look strong. Core profit, the EBITDA number, that grew 16.3% year on year, so 442 crores. And the margins show it too. Operating profit margin, or OPM, went up to 9.3% this quarter from 8.4% last year. That jump really points to some tight cost control. Management commentary backs this up. They said they kept overall expense growth basically in line with revenue, even though they kept spending on brand building and ads. So, yeah, the huge profit spike had that one-off boost, but the operational tightening seems real.
Okay, so tight operations plus a land sale equals good profit. Got it. Now let's pivot to the top line, the revenue. Which parts of the business actually delivered that 5% growth and kind of offset the weak spots? Let's start with the winners. And, well, no surprise here, the cable segment is still the workhorse for Havells.
Absolutely. Cables brought in over 2,000 crores this quarter. That's a solid 12.4% jump year on year. Management talked about steady growth momentum, mostly from power cables, linked to infrastructure spending, B2B stuff. But the really interesting part here is the profitability in cables, the segment margin. It went from 8.6% last year, Q2, all the way up to 13.7% this year. That's a huge leap. Now, management was quick to add some context. They said, okay, it was off a softer base last year, and crucially, it included a benefit from the inventory.
Ah, that inventory benefit. So basically, holding cheaper raw materials, copper, aluminum, while market prices rose. They sold finished cables at higher prices based on the new raw material costs, even though their own cost was lower.
Precisely. It's a nice tailwind to have, but it's not something you can count on every quarter. Still, even with that caveat, they're aiming high. Management mentioned their long-term target margin for cables is like 15 to 16%, so they're making progress.
And the other infrastructure bits, switchgears, lighting.
They were stable, provided good support. Switchgears grew 8%. Margins held steady at a very healthy 22.3%. Lighting and fixtures up about 7.5%. Management said that was mostly because LED prices finally stopped falling so sharply. So yeah, these non-consumer infrastructure-focused segments really provided the cushion for the pain elsewhere.
Okay, let's talk about that pain. We know where the profit came from. Now, where was the company bleeding cash or at least sacrificing margins because of that weak summer in consumer demand?
Yeah, the struggles were really in two main areas. First, electrical consumer durables, ECD. Think fans, air coolers, small appliances. Revenue there didn't just stall, it actually fell 1.8% compared to last year. Came in around 840 crores. According to the sources, the main culprits were softer performance, mainly in fan and air cooler categories. The weak summer hit them, left them with stock. And this drop in revenue really squeezed margins. The segment profit margin went from 7.5% down to just 5.7% this quarter. And it's not just lower sales volume, it's because they kept up those expensive brand investments, the advertising spend. even when the sales weren't there to really support it from a cost perspective.
Right, spending money to push product that just wasn't moving as fast, that'll squeeze you. But the really big sort of red flag was the Lloyd Consumer segment, wasn't it?
No.
Air conditioners, washing machines. That part recorded a huge loss.
Oh, absolutely. The decline there was sharp. Lloyd revenue dropped almost 19% year on year, down to about 478 crores. Management blamed higher channel inventory overhang, too much stock with distributors, and also some lingering effects from GST changes. But the profitability, that's the crisis point. Lloyd went from losing 22 crores in Q2 last year to losing a massive 99 crores in Q2 this year. I mean, that's a six-segment loss margin of over 20%.
Wow, losing nearly 100 crores in 3 months in just one segment. That sounds like alarm bells should be ringing. What drove the loss that deep?
The reports say it was hit hard by significant underabsorption due to lower revenue and higher consumer offers. So translating that, sales were down, meaning fixed factory costs weren't spread over enough units. And second, they had to offer huge discounts and support schemes those consumer offers to get retailers to take the old AC stock off their hands. They basically had to pay dearly to clear out that off-season inventory, nearly 100 crores worth of paying.
So the price of weak sales earlier in the year. Okay, what's the recovery plan? How long are they expecting this drag from Lloyd to continue?
Management seems to think the channel inventories, especially for ACs, should get back to normal by the end of Q3, that's December 2025. They're hoping for a cleaner slate before the next summer really kicks in, which probably means Q3 could still be a bit rough as they finish those clearance efforts.
It's worth noting, too, the recent GST cut helped on ACs and solar, but not really on the other consumer durables that also struggled.
Okay, so this mix, operational stress, strategic moves, it becomes really critical when we zoom out to the half-year picture, right? Because Q1 and Q2 together, the first 6 months, revenue was slightly down year on year, about 1.2%, and net profit was also down slightly, 2%. And this overall softness, combined with that inventory mess, it leads us to maybe the most important finding here, the cash flow situation. Yes, this is the part you really need to focus on if you care about operational health. All that extra inventory sitting in their warehouses, sitting with distributors, for both Cables and Lloyd, it meant they needed a lot more working capital. Let me put a number on it for you.
Inventory days, basically how long it takes to sell stock, it jumped significantly. From 69 days up to 81 days on a trailing 12-month basis.
That's almost 2 extra weeks of cash tied up in unsold goods. That's a big shift. What did that actually do to their bank balance, their liquidity?
The impact on cash was, well, dramatic. In the first half of last year, H1 FY25, Havells generated positive net cash from operations, over 765 crores and healthy. But H1 this year, FY26, that completely flipped. They reported a net cash outflow from operations of nearly 370 crores.
An outflow of 370 crores. They went from generating cash to burning through almost 400 crores just from day-to-day operations. How sustainable is that, especially when they're trying to fund big expansions? Well, the main reason was that change in operating assets driven mostly by an 800 crore increase in inventories. Just think about that. 800 crores of cash that could have been used for investment or dividends or just sitting in the bank. Instead, it's tied up in unsold ACs, fans, cables. That inventory build basically soaked up all the cash the business generated and then forced them to dip into reserves. It's a serious cash crunch.
But they weren't just sitting on their hands, right? They were also actively spending on the future.
Yeah.
This brings us to the strategic investments piece.
Exactly. At the same time this cash crunch was happening operationally, the investing cash flow shows that huge 600 crore investment they made in Goldie Solar. That happened back in Q1. It's a clear strategic bet on scaling up solar. And it's starting to show tiny returns like 4.8 crores share of profit in these results. But that 600 crore outlay, plus their other planned capital spending, it's competing directly with the urgent need to free up the 800 crores stuck in inventory.
So this paints a really complex picture for you, the listener, to grapple with. You've got these really solid, dependable core businesses in infrastructure. But then you have massive operational stress from consumer weakness and that inventory pileup. And while all that's happening, they're making huge capital-heavy bets on solar.
It really is the definition of a balancing act. You know, the profit engine is Cables and Switchgears. And right now, that engine is funding, well, 3 big things. Ongoing brand spending, those significant losses in Lloyd, and this big push into Goldie Solar. But the immediate tactical job, number 1, it has to be fixing that inventory problem in the consumer segments. That's got to be top of mind.
And looking forward, they do seem confident about one thing, even in those troubled areas. They're planning for cost increases from new energy efficiency norms, the BEE standards for fans and ACs coming January 1st.
Yes, they explicitly said they expect to pass those costs entirely onto the consumer. That confidence suggests they feel they still have pricing power, which is key, but it doesn't solve the immediate cash flow issue from the current inventory glut. Their strategy needs cash, and right now, operations aren't providing it like they used to.
Okay, so we've seen this massive cash outflow driven by inventory. We've seen the 600 crore bet on Goldie's Solar, and they're planning to spend even more FY26 capex projected around 5,450 crores. This sets up our final provocative thought for you to consider. Given all these commitments, what's the bigger risk to keep an eye on in the next few quarters? Is it the short-term scramble to clear out old stock and get operating cash flow back into positive territory? Or is it maybe the long-term weight of these huge investments in new areas like solar needing massive cash before we know if the returns will fully materialize?
It's really that classic tension. Short-term operational health versus long-term strategic ambition. Hopefully, this deep dive gives you a clearer sense of Havells' Q2 performance and, the tightrope they're walking right now.
Thank you for joining us for the deep dive. We'll be back soon with more insights from behind the numbers.